All right, what's up, folks? Today is January the 1st. Hello, New Year. So, pretty much this year, as I've kind of started doing before, I'm just literally going to make, I want to make videos every day. So, and it's primarily just going to be working on coming up with a script for what happens in the day. So it's not going to be anything elaborate. I'm not going to be doing a whole lot of, well, I guess you can consider it to be back testing. But I'm not going to be running performance reports and optimization reports on every little script that I do. I'm just literally going to be just trying to make a script that fits the dips or the supply demand, whatever zones for every day for the chart. Maybe the 1 minute time frame, maybe the 5 minute time frame, but I'm just going to be doing something. So typically it's going to be fairly quick. Hopefully it should be quick. Hopefully it should be like 10 to 15 minutes, and it's just coding, really. So maybe a little bit of TA, technical analysis along the way, but primarily coding. So feel free to join along, or just look for the parts where I get to the end of the video, and hopefully I have some reproducible or some consistency in my entry triggers. So you might just scan through the video and see how the progress goes. Yeah. All right. I'm going to pull off of here and just get to coding. So let's see. Is anything going on today? Yeah, markets are still closed. Okay. I know for Christmas, I think markets were, or at least futures was still open. So let me just make sure. See, 24-hour. Nothing here. 24-hour? Really? You want to do that to me? ES? Yeah, I guess even futures are not. It's not doing anything today. So, all right. So I'll just pick. I'll pick. Yeah, Friday, and come up with something for Friday on maybe the 1 minute time frame. Okay, is this what I did? No, this is just dip ES, and dip ES again that I created for ES futures here. It looks like it definitely worked on that uptrend, and but I created that the third week of December or so I didn't exclude very well these other areas. So I'm going to get this off of the chart here. I'm going to get these other this yellow one is from the 28th. This blue one, I think the blue one is also from the 28th. I thought that was a 5 minute time frame, but either way, I'm gonna get all this off, so it's just gonna be a fresh chart, and then I'll just work with what I got. All right. Let's see. So let us go here. We're gonna take off any of these little dips, any of these little dips that we have on here, and then we will start fresh. Okay. All right, give me a second. I'm gonna clear out some of this background noise. It's, family is home, daughter's home. She's, we redid her room. She loves it. It's awesome. So she's hanging out in her room, and yeah. So, you got to be thankful. You got to be thankful in this new year. You get every day. You got to be thankful every day for sure. All right, let me hop up and change that, and I'll be right back. Okay. All right. Let me get some music going or something here. Okay. got to get some music going. And of course, you guys won't be able to hear the music. I don't know how that works with monetization. I'm not monetized or anything like that, but what I'm saying is that I don't want it to be taken down for, copyright violations and that kind of thing. So I don't think that you can hear any of that. Yeah. All right. I think we're good. All right. So, yes, this is December the 29th. Let's remove the regression and the regression slope because right now it's just extraneous. We'll determine what we need as we do the chart here. All right. So, and typically I'm just looking at, market trading at regular market trading hours. So from 9:30 to 4 o'clock. I'm not really looking at the lower liquidity time frames, after hours from 4 o'clock the previous day to 9:30 day of. And I really want to capture, I think yesterday what I did is I put together 2 scripts. So I did one for the 5-minute time frame, which identified where we have a good indication to get in from the 5-minute time frame. And then I made another script for the 1-minute time frame to say, okay, well, when we get that indication on the 5-minute time frame, then we want to look at the 1-minute time frame and we want to find a script that works well there. So if we were to do something like that here, pretty much we'd just be saying that we identified that we had a significant swing low on the 5-minute time frame, right? Boom, 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 larger time frame, significant swing low. And then from the swing low, now we want to look for any of these dips, these pullbacks on the way up. All right, so any of these. All right, so we'd start here, so we probably wouldn't include this. We'd be looking for that dip. We'd be looking for that dip. And this is the end of the day. Typically, the strategies that I set up, I don't allow them to show me an entry at the end of the day because then you're approaching lower liquidity. And so that's why you have a lot more volatility here. So we could look for these guys. And again, I've learned that these scripts aren't going to be 100%. So don't expect for them to be. All right, let's open the coding, the trading, the development environment, and then get them side by side. All right. And then show me. This is the 1-1. We're going to do ES 0101 24. 24. First script of 2024. Let's go. All right. So this is going to be 1 minute. All right. And of course, all this that already populates here is it's just a template that I put together. So it pretty much just has everything already in place. So I can just start coding right away. So all these conditions being true will lead us to have an indicator pop up on the screen. So if I was to save this, and then go over here and open up ES 1124, show me ES 1124, 1 minute, boom. All right, so everything would light up, right? Every single bar would light up because all these are true. All right, so now we need to find what's happening at these dips here. What's happening at these dips? Why are these dips significant for a valid entry, a valid pullback, a valid, low side? All right, so one, we see that we got a large red bar, we got some long red bars. This is a long bullish bar, but we obviously can't take this because at that point we're getting in at the top. No long red bar there, not in relation to the rest of these. I mean, there is, but and I haven't coded like this before, so maybe I'll try this for the first time today. I see that it could work, but let's try it, right? So we have multiple sequential red bars, and in totality, they would equal a long red bar, right? So if I was to code for something like that, again, just because I haven't done that before, I'm going to just try coding for that. See what it looks like, and then, like I said, I'll go back to the rest of the code later. So in my head, what I'm saying is there are at least 3 red bars that don't make a, let's go this. So, oh. Come on now. Why'd you do that? All right, 2024, don't go playing tricks on me. Scaling is off for some reason. Let's see. Yeah. Okay, so this is a chart that I have multiple time frames on. So, and whenever I'm doing multiple time frames, especially if I change the session like I did just a bit ago, it always screws things up. So I tell you what, instead of doing it here, I'm gonna go into mess desk down here, which is where I do a lot of my messy work here. Open that up, and then we're gonna move that back to ES, and then we'll put that on the 1 minute time frame. And let's get rid of some of this other support and demand indicator. And are we on 24-hour session? Okay, now we're just going to go back in here, and we're going to identify this area. This is what we're talking about here, from here to here. And then we want to find these entries. It's always a good idea to identify them. And this is kind of like using the concept of using the larger, the higher time frame to identify what you want to do, instead of looking in so close that you can't get what you want. All right, here it goes again. Let's see, did that? No, okay, it kept it 24 hour. Okay, so that zoomed way in is what that did. Awkward. All right, so I did Q. All right, there we go. Huh. All right, well, just playing with the scaling here. But okay, so what did I say? I said I want to identify at least 3 red candles, right? 3 red candles in a row that don't make a higher high, right? So this is the high. This does not have a top wick, which is fine, but the next candle does not make a higher high. If it had a wick at the top, it could be a bearish candle like so, and it could have a wick at the top, or like this next candle could be also a bearish candle, but it could have a wick that comes up and makes a new high, and we don't want that. So we're looking for at least 3 bearish candles that make lower highs. All right, so that's going to be the first condition, and I think I'm gonna make this a separate condition altogether. We're going to call this condition 10, and it's going to say that there's a bear, which is bearish candle, and bearish candle of 1 bar ago, and bearish candle of 2 bars ago, right? And so now we're establishing that they're all bears, that they all have closes that are lower than the opens, and we got to say that the lows are all sequential, the highs are all sequentially lower, right? So we have to say that the high is less than the high of a bar ago, and the high of a bar ago is less than the high of 2 bars ago. It's 1 bar. All right, so that should be our 3 candles, I do believe. All right, so that's gonna be condition 10. So with all these other conditions being true, because we set them as true, we're just gonna add down here and condition 10. And then verify that. Now we go over here, and because we're on that new workspace, we need to open the show me 1-1. Where is that? Yes. Okay. All right, I got some errors here. What do we do? Condition 10, bear and bear and bear and high. I not put a colon? This is what happens when you work on this shortened screen. I'm doing it for you guys. This shortened screen. And, oh, I lost condition 10. Verify. All right, come over here. Show me 1/1/24. That 1 minute time frame. Okay. All right. So you see what we got, right? We got 3 bears with lower highs, right? 3 bears with lower highs. Okay, and so then we get the entries here. Now, all 3 of these fired, because this starts bear 1, bear 2, bear 3, enter. Bear 1, bear 2, bear 3, enter. Bear 1, bear 2, bear 3, enter. Right? Here we have bear 1, bear 2, bear 3, enter. Right? So we don't want to take all 3 of these entries. So how can we account for that? Well, let's look at volume. Volume down here of these three groups, we have a lower volume. It progressively increases. And look at this one. This volume is the highest out of all 3 of these. And then we have a lower volume. What happens over here? Same thing, right? Lower volume, mid volume, higher volume, and then the volume drops down again. So we could say we want all 3 of these things to be true, and we need the volume to be lower than the volume before it, right? Does it work on this one? It does work on this one, which I'm not terribly excited about, because this is not a lowest low, really. I mean, this is a lower low than this is. But this is also kind of a little bit of a trap too, right? Because at the top of this resistance turn possible support, now you're thinking, oh yeah, good place to enter, right? But then this is the next area, right? But this is actually the better entry. All right, but we're going to come over here and we're going to say that not only do we need condition 10, all these bears and these lower highs to be true, but now we also need for the volume, or the ticks, it's called the ticks on here, the volume to be lower than the ticks a bar before it. Verify. Now we just have boom and boom, right? We still have this one, like I said, the volume is lower than the volume before it. Ooh, we move out and we still get this one too? All right, and we get this one. This one is no good. And even in this range though, what's happening here? Well, I tell you one thing that I don't like. One, the overall range of this candle is really high, right? So for me, that's a non-starter anyway, right? It goes up. So, and then the question is whether or not this went up before or after, right? So did the candle start here, move up, and then retrace all the way? Because, right? But that's a huge rejection to the upside. Right here, if we were trying to identify this area right here, there's nothing really. I mean, there's this area right here, resistance, turn, possible support. But I mean, that was broke here. It wasn't respected here. So why would you expect for it to be respected over there? Right? But over here, this area over here does, to the left of it, it's definitely got this area here, right? Also the lower aspect of this right here. So this is not a good area, but like I said, I don't like for this to be super long like this. Look at these. These bars are short. I don't like for this to be super long. Plus, a top wick like that is no bueno, right? If we set condition that excludes bars that are really long, we lose this one here. And I think that's appropriate, right? So we'd only get these 2. We get these 3. And those 3 are great entries. I don't know what it looks like on the rest of the chart. I'm not terribly interested in it. Like I said, I'm really interested in what happens above this yellow bar here in this uptrend. So let's do that. So we're going to say that the range has to be lower than I'm going to say the range has to be lower than the average range of 7 bars, which I have put as range 7. Okay, so we did lose these guys. So the range of this candle is definitely smaller than the range of these. The range of this candle, and so when I put range, I'm looking at the overall range. So this has a bottom wick, which is also acceptable for a reversal candle. Narrow candle, or candle with a nice long bottom tail. So the overall range from top to bottom is long, or it's likely longer than the average range of 7 candles. So we just talk about the body, right? So the bodies are from open to close. So from the hollow part of the body, the hollow part of the candle, if you will. So from the open to the close, boom to boom. That is short. Open to close here is long. Okay, so we're going to say the body of the candle is smaller than the average range of 7 candles. Verify that. All right, so now we get those back. We actually get this one too because that body is longer. However, okay, I'm just listening to music on the on my earpiece, and I hear a commercial come across on YouTube, and this dude sounds just like me. I have very rarely heard anybody where we have a very similar voice. That's crazy. Okay. All right. So sidetrack. All right. So what we're going to do is we're going to say that the not only does the body need to be smaller than the range of the average 7 candles, but also we don't want that super tall wick. We don't want that top wick like that. So we got to say that the top wick is less than the range of 7. Average range is 7. I could relate it to itself so that it doesn't have a super long, tall wick in relation to the body. Let's do that. I think that's an obvious observation, is that you don't want the top wick to be greater than like twice the length of the body. All right, so top wick is less than the body times 2. All right. All right, so now we do have this one. We got those 2. We got those 3. These here are, that crosses the green line. That crosses the 25 pair moving average. So does this one. What happened up here? Another obvious one that I see. One thing that I don't like, just from the technical analysis standpoint, is that this candle here has a really long bottom wick, which this would be okay by itself, but oftentimes you got to look at that long bottom wick. You do want it to be in this range of like a resistance turn support. One candle down is pretty aggressive though, right? One candle down and back up is pretty aggressive. So this would be a little bit of a danger area, but that next candle would definitely need to be a small range candle in here. And this is not. This is a longer range candle. So we need to compare our entry candle to the candle before it. And I think normal technical analysis would say that you typically don't want to have a lower low lower than a candle before it with a huge rejection. So logic written down would look something like candle before it is a bear. So let's see. Bear is the candle before it, and the low of the current candle, and low is lower than the low of the last candle, and that bottom wick is super long. So we're going to say that the bottom wick of a bar go is greater than the body of a bar go times 2. All right, so if all that's true, then we don't want it. So we need to say that condition 11 is false. Can we do that right there? I don't usually do that right there. I don't usually put this right here. Yeah, but it liked it. Okay, all right, so we did get rid of that, right? Because pretty much we said that we don't want to have a lower than the entry candle should not be lower than a huge bottom rejection candle before it, right? So if the candle before it was a huge bottom rejection, that's great. But now if you're going lower than that, then that rejection wasn't really valid then, was it? It's still working. All right, so we got rid of that one. All right, so pretty much like I said, we identified those out of this range here, which is what we're looking at. We didn't get anything here. That's okay, but we got this one, this one, this one, this one. So we didn't capture this guy, or this guy. This one here was just such a quick wick down, and it was literally still working on breaking that descending trend. So this one could have been premature anyway. This guy here, like I said, I think it was a little bit of not a fake out, but just a dig deeper into a stronger demand zone. So like I said, this would have been the initial range in here, and this was just a dig deeper, which is okay, but I didn't capture with this. Okay. All right, and that is obviously a pullback, right? So in through there from this descending trend. Now the question is, you can go there or you can go here. Where are you going? All right. So the question is, you see it worked here, boom. Here it didn't work, and here it didn't work. So, all right, these are above the 200. The red line is the 200 period moving average. These are all happening above the 200 period moving average. So maybe I'll just put another bit of code on there that just says that we need to be over the 200 period moving average. That's one of the easier. It's a lagging indicator, right? The moving average, because it's taking the data from data points before. So if it's taking information from data points before, then it's a lagging indicator. But by the time you cross the 200 period moving average, even though it's a lagging indicator, by the time you cross it, it gives you an idea that you have already started into the into that next side of the trend. So here we're on the bottom side of the trend, downtrend. Here we're on the top side of the trend, uptrend. All right, but it's not terribly strong. It's just got over it, and the 200 period moving average just starts moving in a positive slope here. All right, so I mean the 200 period moving average is sloping down here, so it's still moving down, and it just starts getting over it here. But the 200 period moving average doesn't change to be positive sloping until here. So, all right. And I know once I get rid of that. So, for instance, you see here, this one works, right? This 200 period moving average is slightly sloping up, but it worked here. Here, these it didn't work under, so it's under the 200 period moving average. It didn't work there. Here it's under it, and it did work there. And so these are some things that I'd start looking at, like right here. If you look at the slope of the 200 period moving average, it's kind of leveled out, but it's kind of starting to go down here. So one of the conditions I could put on there would be that the slope of the 200 period moving average is at least sloping up. So that lets us know that, like I said, it's lagging indicator, but if it's sloping up, then we got more of an indication that it is uptrending. And if we went back to this day here, if we put that this 200 period moving average was sloping up, we might capture. I don't think we'd capture this one because this is still sloping down. 200 period moving average here is sloping down, so we lose that one. We lose that one. I think the safest thing to do is just say that the open is greater than the 200 period moving average. Boom. All right, so we'll keep those. All right, so we'll keep just working on my scaling here. We'll keep those 3. We actually kept that one 2 because we said that the open is over the 200 period moving average, and the open is right here at my mouse, and it is over the 200 period moving average. Boom, moved up. All right, and so now that we're going back, this is after hours time. Ooh, looking good. Okay, so it worked here, got in just before this bump up, worked here just before the bump up. So really I'm looking for places where it doesn't work, because that lets me know that my code is not working so well. All right, here you would have got in down here, and you know, if you were looking for a stop loss zone, I mean, you might be looking all the way down here. So as the chart moves up, and I thought we talked about this the other day, as the chart moves up, you're moving from demand to supply, right? So if the chart is already up and then it kind of starts hesitating, so you may think that this would be a good area for a continuation, but typically you would expect that it would be bouncing off of something in this area. Continuation, bouncing off of something. That plus you have all these tall wicks. So this would not be a great area to do a continuation from, because you need to shave all these wicks off. All these wicks say, hey, we tried to go exponential and we couldn't do it. Or we're looking for people to get in, and we're taking their positions. We're looking for them to go long and get in exponentially, and we're going to take their positions. And you did, right? And you shorted it. So this would not be a great entry for a continuation anyway. So if you were to get in on that with this entry, I mean, you got to expect that you're going to be bumped down right there. And then you got to expect that your potential support is in this area. And when the chart came to this area, it didn't even hesitate. It just swung right through it. I mean, but of course you have all this aggression up here. So it took that aggression, it distributed, and it sold through. Okay, but that is not, I mean, if you were to get in right there, like I said, if you consider your stop loss to be down here or at this wick, and you look for even a 1-to-1, I mean, you might have got out on that wick there. So still not a bad one. I wouldn't consider it a dud. Now, I do consider this to be a dud. It is at the lower side of a move, so you could get in and move your stop loss up immediately. But again, you know, where are you bouncing off of? Are you think you're bouncing off on this area? That's a pretty aggressive move to bounce off of. So it worked there. All right, this is after hours, so I tell you what, let me go ahead just for kicks and giggles. Let's say that the time has got to be greater than 0940 and time is less than 15. I think I do 1550. Okay, these here are no good. that similar thing that we were talking about before, where you have like this exponential move up. You're moving from demand to supply, and with that move up, you have this huge rejection. So you don't really expect for it to continue on up, and it doesn't. It does its hesitation, it sells off, and so the question is, are you trying to use this as a potential support zone? So I mean, I get it, I definitely get it, but it didn't work out, so that'd have been stopped out. Orientation. Sorry, gotta keep changing this scale. Okay, I don't remember how far back we were. All right, that was a good push up right there. That was a great entry for the push up right there. This was a great entry for this move up. This was a pretty good entry for this pullback, and you got this potential support right there. So I think it's working way more times than it's not. Okay, guys, we have a geriatric dog, and I gotta put her food in water and make sure it gets nice and soft before she eats it. So her food is ready. It's soft by now, and she wants somebody to feed her. So I should probably go do that. These guys here work pretty good too. I mean, this is another really good script. Bam. This one, yeah, maybe not so much. How many times will you bounce off of this same area? I don't know, maybe a third time. But this is a huge red candle here, though, coming down to it this third time. Plus, it's kind of coming through this ascending support. So that'd be a little bit dangerous to get into. This huge red candle here, that'd be a little bit dangerous to get into. This one here didn't work. This one did work. Again, still, we are doing way better. Man, just coming up with that. That is cool. I like it. And like I said, I kind of promised myself that I'm not going to make these things too long because I'm going to do them every single day. And so I think I'm going to hop off here. But like I said, this is a script that I put together for, what is this? December the 29th. And pretty much the condition says, and I guess I'll say the condition so that if you're looking to trade it naturally or manually, you can have a decent idea. It does get a little complicated, so hopefully you followed along, or you can certainly go back through it. But the main thing that we're saying here is that we have 3 bearish candles, all of them making lower highs, and I think, yeah, all of them making lower highs. We didn't say anything about the volume of them, but we are saying that the volume has to be lower. The entry candle volume has to be lower than the volume of the candle before it. We're saying that the body of the candle has to be smaller than the average range of the past 7 candles. So it's okay if the range is a little bit longer, but we're just saying that the body has to be smaller. But now we are saying, as far as the top wick, that the top wick of the entry candle has to be less than twice the length of its body. So we're saying that it can't have a really tall top wick. It can have a top wick, but the length of the top wick has to be less than 2 times its body size. All right, then we're saying that the candles that we're looking for, they got to be over the 200 period moving average, which just helps confirm that we are in an uptrend. And then we're not using this script for trading times at the very beginning of the trading day or the very end. We are looking at the futures ES, so we're not looking at the to take trades during the typical aftermarket hours either. So from 4 o'clock in the afternoon to 9:30 next day. And then what is this one? This is my last condition. We're saying this was one that was, this was the one that was saying, so condition 11 here, this is saying that the candle before it, this is actually an exclusion criteria instead of inclusion criteria, the exclusion criteria. So we're saying that for the entry candle, the candle before it cannot be, and then we're going to encapsulate this, it cannot be a bearish candle where your current low gets lower than that bearish candle, and that bearish candle, that candle previous to our entry candle, which is the bearish candle we're talking about, it cannot have a wick that is really long. And by really long, I mean it can't be twice the length of its body. Okay, and that's pretty much it. So we didn't use swing highs and swing lows. We didn't use any of that. We didn't use the rest of the values here. We used condition 1 through 5. We added condition 10 and 11. Condition 11 had to be false. The rest of them are true. And this is for the 1 minute time frame on ES, and it worked back pretty well, at least 10 days. All right, guys, I hope you got a little something from it, and hope maybe you get inspired to, if you don't trade with coding, then at least trade with some rules. These are all rules. I love rules, but I mean, you know, like they say, you know, rules are meant to be broken. But when I trade, when I trade manually, I don't do a good job about abiding by rules. So my strength in 2024 will truly be identifying these rules, capturing them in scripts, and just using the scripts to augment my trading, because I'm just bad about following rules. I just like doing stuff. If you know me, I like doing stuff. So I'd rather do something than do nothing. And so when you're sitting here waiting, trading, unless I've got something else to do, which I really don't, I really don't have anything else to do. Unless I've got something else to do, maybe I could read. I don't know. Unless I've got something else to do, I want to do something. So I'm going to place a trade. But like I said, and the only reason I moved over to TradeStation from like Thinkorswim, because Thinkorswim has a pretty robust trading environment or coding environment as well. Only reason I moved over is because with TradeStation, you can actually tell your scripts to trade for you. Now, if you're not doing it right, you can certainly lose money doing that because the scripts will be wrong, but you can make your scripts, which is just this. I'll just take this, copy, paste it over into a strategy, put the strategy here, and then it can buy and sell for you. You could sell short, buy the cover. And then here you go to generate strategy orders. And then here you click automate execution, and then you can tell it to do confirmation on or off. If you do it off, then as soon as that trigger comes on, as soon as this dot shows up, it's going to place a trade for me. Boom. And then I can manage the trade thereafter. Or I can tell it to start a position with the confirmation on, where like the chart will be going and I'm doing whatever I'm reading or something, and then it'll say, hey, you know, the strategy found an entry. Do you want us to place a trade? And then you got to go from here to here and say yes, and then it'll place a trade. Whereas by that time, like you want it to get in down here, right? So you want it to get in here at the bottom of this candle. So on the next candle, it would enter an entry by to open right here. But if you're reading or if you're doing something else, and then as soon as this candle ends, you should have got in here where it gapped up a little bit. So that's kind of cool too. I don't see a lot of gaps, but maybe next time when I get on tomorrow or something, I'll put in some criteria that looks at the gaps, because I know on a lot of other like highly liquid stocks and charts that I look at, there are very few gaps. But now sitting here looking at this, I see plenty of gaps. So I have to incorporate that into my code, because most of the time when I'm looking at these, like if I'm looking at Tesla or something like that, there's very few gaps. It's highly liquid. There's very few gaps. When you see like dojis like this, a lot of times there's lower liquidity. But with ES, I would imagine that there's enough liquidity, or trading the SPY or something like that. But I mean, there are some gaps here. So anyway, if you're doing something else and then the time you turn around and you come back to the computer, now it's moved up. Well, I mean, your risk to reward relationship is skewed. It's screwed, right? So using the automated strategy part of it is, definitely valuable. I could see that being super valuable. But anyway, I'm Eric. I'm out. Peace.